Can you post? Okay, okay, good. Can you all post on your app like we are online, just to help others know that we are here, so they can come and connect with us. But for me now, I'm gonna focus on the call. If you want to share the link, you can share it on a cycle, so people will come and connect. But let's start this call. I'm trying to show you how I made these fantastic trades today, and I'm still in one. I am in this gold trade right now, but I will explain to you because remember the title of the call. The title of the call was I will show you a strategy, the strategy that I've been showing you, but today I will explain it in details. So I want you guys to take notes and really focus on what I'm going to say here. Okay, so the first thing is I'm going to open a checklist. I want you to understand that every strategy must have a checklist. You cannot come on the market on these charts and just expect to do stuff without checking nothing. Okay, so the first thing is this. You have this is the fractal ECR model. This is my own strategy. I mixed a lot of stuff that I've learned here and there toward my experiences and my trading years. So you should understand one thing. First of all, you're gonna take notes. That's the first thing. And secondly, we're gonna go from the higher time frame to the lower time frame, step by step. After I explain every step, we are going to go now on the chart. And from that, you will understand how to execute this trade. And I will show you the examples that I did today. Okay, guys, I hope everything is right for you. But let's create another profile here. Baz, and good. Let's go with that one. Okay. So I'm going to go on Euro USD. Oh, it's already in my zone. Oh God, I was not expecting this. It's reached my zone. I know the price is turning around. On M15, if I look here, I have a break. Price just swept liquidity here. And if I go on M5, I should see a break in market structure. But for now, all I'm seeing here is just an engulfment. From the M30, I have an M5 that broke structure. I have this one here. I can take this second one. This is my second option. And I can take a trade, but now is not the right time to take any trade because the PM session is already started, and we're gonna close the session, gonna close the day in 4 hours, like in one H4 candle. Can you see that? If you put your mouse here on this candle, it's 9 a.m. Here it's 1 p.m. The next candle will be 7. It will be the market's close. So we are not gonna care about this setup. Sometimes the setup will happen at the wrong time, so we're not gonna take this position. But we know price is about to drop, mostly because dollar gained some strength today with the news, and euro has shown weakness, and we swept the Asia high, testing yesterday's highs, sweeping the Asia high, and breaking structure. This was just a pullback from where we should sell. Okay, so this was just a comment because I didn't know that this happened on Euro USD, but I'm going to explain to you step by step this strategy here, the fractal ECR model. I've talked about this once and many times on my YouTube channel, but today we are going to go in depth. So I want you guys to really take notes. I've given you time to prepare your notepads. Let's go into it. So the first thing is you must understand that it's a supply and demand strategy for gold and forex. Fractal ECR. ECR stands for engulfing candle range. Okay, and this strategy is very easy, but if you understand liquidity, you will make the most of it. So it works with Euro USD, GBP USD, Euro JPY, GBP JPY, Euro AUD, GBP AUD, and USD JPY. I've tested this strategy on these pairs. I never tested them on indices, but I know some of my friends who know use them on US 30 and maybe NASDAQ. But I'm showing you these lists because I want you to have options. If we have 1 week where there's no opportunities, I want you to be able to change the pair or choose another instrument so you can take the entry on a weekly basis. Okay, like every week you should have like 3 entries, 3 possible trade, or 3 possible ideas, and that could be enough if you manage your trade well. Okay, so Euro USD, GBP, Euro with JPY, GBP also, Euro with AUD, GBP also with AUD, and then USD JPY. So this is the strategy here. The first thing is the daily and the weekly. We have to find the recent structure and the price action. Higher time frame, recent structure, and price action. When you check this, it means you understand what it means. Let's go here. When you come here, what do I mean by structure? Where is the last break of structure? If you see something like this, you know this is the last break of structure. Okay, so the higher time frame means what? It means you're going to play around with the weekly and the daily and understand where we are. Imagine we are somewhere here, so you know we are inside of this range. We broke structure, we are going back inside the range. So if I have to trade 1 week, maybe that week will be just this move. Maybe I'll be bullish. But if I arrive on this chart and I find myself here, I know we have reached the 50%, we have made a turn, and we are dropping. So the target is here. So the next week will be here. Okay? So for me to understand this, you need to look at the relevant highs and the relevant lows, the last break of structure. So you know what range are you playing in. Okay? You have to know your dealing range. So now, when you ask yourself this, you should ask yourself one thing. When the price is making higher highs and higher lows, you should know price moved from internal range to external range liquidity. What is external range? All around the swing lows or swing highs according to your direction. If I see this, for example, price was dropping, left this guy here, this is an internal range liquidity because it is internal to this guy. It's internal to this. So if my price comes and take this out, it took out the internal range liquidity. Most of the time, it will stop inside of an imbalance or a fair value gap. Okay? So I'm going to go a lot more deeper in this subject. Let me show you here. Boom. So you have here, when price return in the range, you can have imbalance here, and that imbalance is where you should expect price to reverse, and from there you will see price change direction. This is an internal range liquidity. Internal range liquidity, I can also call it internal point of interest, because this is where I'm expecting price to react. But when price is somewhere around here and it created the reversal, now I'm expecting to see price drop toward the external range liquidity. External range liquidity is just swings like here. You have a swing low. When price breaks it out, it broke the external range liquidity, then it will look to come back into an internal range liquidity. So we move from internal range liquidity to external range liquidity. Now, I want to make this clear so everyone remember what internal range means. Okay, let me just remove everything here. How to know about the internal range liquidity? I need to tell you again, you have many types of liquidity. And what is liquidity? Liquidity are just resting resting orders, okay? Resting orders or limit orders on and stop orders that are waiting for to be activated by the market, by the price, okay? Let's imagine something. Price is somewhere here, right? There are people who expect price to come at this level. Let me create a line. People expect to see price come back here. And from this level, okay, from this level, they want to see price activate their trades, and then they can sell. Here, it's a sell limit. If they put a sell limit like this, and this move did not happen yet, then there is a position that is waiting here. That is a passive entry. We are waiting for price to reach this level so we can start selling. This can be targeted by smart money. Let me show you another one. This was just a way to activate the trade. Imagine you have entered another entry, you took it at the breakout here. Once we broke out at this line, I started selling, but I put my stop loss around here, and then I target somewhere here. The problem is, sometimes we think stop losses are not execution. Stop losses are market executions. Why? Because as soon as we reach here, I will sell. You see, I was in the position, but it will take me out. Okay, in this case is to buy because we are selling, but when you're selling, it will be to buy. So I'm expecting to sell at this price here. So let's imagine this is $80, okay? And now here, it's $100. Price is higher. So if I want to buy, okay, something, will I buy it when it's expensive or when it's in discount? When it's in the discount zone, you will make more benefit because you bought it cheaper. Here it's expensive. So imagine you told yourself, as soon as price did not reach 100, okay, I'm not willing to sell this. So when price will come here, okay, me, for example, me, if I'm the seller, I'm waiting to sell, okay? When you reach 100, now I can sell. To sell means to get out of your buy. The buy, I'm out of the position. But when I'm selling, it's the opposite, okay? I want to buy at the cheaper level, but I want to sell at a higher price. So when price will come back here, it's not a good deal for me to buy. That's why I say I was selling, but market wants me to buy here. I was trying to go with the market lower, but the market decided to bring the price higher and take me out. The stop loss is an execution then. That's why I'm saying this. Execution can be an entry. It can also be a stop loss. And all these things here will be liquidity. Because when this price will take me out of this position, I will lose money. Here is the same thing. I was waiting for price to retest this level. I was waiting for price to come and retest this level. It came and retested, put me in a good direction, and then came back and took me out with a loss. All this money accumulated from a lot of people will create a pool of liquidity, and it will give the market a counter for the operation they want to create. If they want to sell, they will have enough buyers. If they have to buy, they will have enough sellers. But this is just because the market wants to be balanced. Market cannot go high like this and never get down. It also have to come back down to rebalance, so at a fair price, so some new sellers can sell and new buyers can buy. Okay, so If you understand that common explanation I just gave on liquidity, you should understand one thing. I was giving you the steps here. We go back again. First, it was higher time frame, recent structure, and price action, point of interest, and premium and discount. Point of interest, it's internal and external range liquidity. Premium and discount, you know how we do premium and discount. When you have a range, you can mark the 50% of the range, and you can expect price to give you a movement. If I take my 50% here, let me take this one. I take this, price came back in the 50%, even here, okay? You see price moved up, created the range from here to here, and then it went and touched the 50%. This is premium, and this is discount. That's all you need to think about according to premium and discount. When it's up here, I want to buy, I want to sell, but when it's down here in this zone, I want to buy. Okay, so you will not be against the trend. Okay, point of interest, it's internal range and external range liquidity. Most of the time, you will find them on a higher time frame. If I go here, the same move that I just showed you, let's look at it on H4. What do we have on H4? We have a retracement inside this line here that you have. You see? This is a zone of retracement. It was a resistance that became support. Okay? But also, if I look on a higher time frame, I have a fair value gap. You see? It's a fair value gap. Fair value gap means imbalance. Imbalance for me and for you now, it's in internal range point of interest or internal range liquidity. Now, when price is moving from here, we expect price to go here. Because why? This wick is showing where the market left the stop losses. I told you about it. If where the stop losses were here, then this is where we should go. That is external range liquidity. Why? Because it's outside of the range. You see, the range starts here to here. The liquidity is down here and up here. All the liquidity that it's inside of this high and this low, it's internal. We have this fair value gap, we have this gap, we have this guy here as a retracement. All these levels are internal range liquidity. Okay, so on a higher time frame, if we know that we have internal range liquidity and we came to retest it, like I marked here on the daily, for example, let's see if we have something. Okay, on the daily, we see here we have another internal range liquidity on the daily. Okay, we just took another internal range liquidity here, and we are moving up. You see, we have another internal range liquidity here, and we are moving up. So, in simple terms, first thing you do when you come in your market, you need to look at the higher time frame, recent structure, and price action. The easiest way is to find the last swing high, last swing low, and the breakout structure. And from there, you can find your premium and discount. And then you will also focus on internal and external range liquidity. But if you know the premium and discount, sometimes you just don't need the POIs because the rest will help you. The next thing you do on a higher time frame is the NCT. NCT is a term that I also put up together called next candle theory. The next candle theory, what day are we in the week? You should ask yourself that question every week. What day are we? According to the week, what day are we? Because if you don't know what day you are, you cannot expect to know the behavior of that day. Okay? Let's go. If this is the beginning of my week, this is the beginning of my week, and this is the end of my week. When the week opens somewhere around here, this is the opening price. So what I'm seeing here, the opening price of the week, if price start by going lower, These are days that are passing. Okay. So maybe here we have Monday. Maybe here we have Monday. All the green here is Monday. What did price do on Monday? We came and closed bearish. Okay. That could be Monday. Then we have Tuesday. Tuesday could behave differently. I can change the color here. You have Tuesday here. And then you have Wednesday. Retracing inside of POI, and then start moving like this. And now you have the next day here. Always think about how time is subdivided. You see, you have Monday, green, Tuesday, Wednesday, and then you have Thursday and Friday. Okay. I'm showing you this why? Because you need to understand when you need to expect certain stuff, a certain movement, and certain price action in the week. Especially if you have news, you have to understand why price is not moving yet. So now here, I'm just showing you this. It's a random price action that I'm drawing. This could be a week. The week opened here and then closed here. Let's represent this week with a bigger candle. Okay. So we opened here, we closed here, right? We opened here and closed here. Now I will take this and mark my week. So the highest point could be here. Why? You see? Well, here, where we reach the highest point. Highest point could be here. And lowest point will be here. Okay? This is how you will see the week at the end of the session on Friday. This is what the week will be. But it's a green one. Why? Because we opened here and closed above. So that candle will be a green candle. You see how the week forms? So if you want to expect and catch the new week, you should see how this week behaved according to the previous week. If the previous week was also bullish and we had a week here and this here, you will mark the break of the previous week and tell yourself how the previous week close according to the one before. When you say how this candle close according to the one before, you only have two cases. Either a close in the breakout, means my candle broke the high and closed above, or I close in a fake out. Fake out is when you have the candle reach here but come and close inside, for example. And if you have something like this, the closing inside means the price action was different inside here. It was not the same thing. It means the price action was maybe something like this and created this, came and closed here. The highest point was here. You see, maybe price played this way for this week. So you should ask yourself, how did the previous week closed? So what am I expecting? The rule is simple. Write this down. If the previous candle broke out the one before, my target is to go and get these highs here. So when the price will open at some level, it will start by creating a low movement. So you will see Monday and Tuesday go lower, and then Thursday, Friday, and Wednesday will go higher to go get this level. Sometimes the price action will already come and get these highs. You need to observe now at that point if this price is not falling inside of a internal range liquidity. If it is, then you know price has created the highs. Why? Because it's trying to reverse. You see, this is the case in when you have a candle that closed in breakout. Let's go now for the next one, the next case. When the candle did not close in a breakout. When the candle did not close in a breakout, what the price will do here? You have something like this. You have a bullish candle, then we opened, created a big move, and then came and closed bearish, for example. Okay, we closed bearish. We swept here. What are you expecting? Next day, we'll have to target this guy. The lowest point here will be our target. Why? Because when price will open, because it's a bearish one, it's closed down here, we will have a push up on Monday and Tuesday, and then from there, we can have Wednesday and Thursday go lower and target this low here. If you keep that in your head, okay, you will be right 7 to 6 out of the time in direction in this market. Okay, so this is all you need to do on a higher time frame. Let's come here and see on the daily together what did happen here. I will just mark the lowest point or the highest point, and then you will see by yourself where the next candle did go. So we can start here and then we go back. We can even go back in time, more like here, and then you can see by yourself. Look, first of all, okay, guys, focus. We have this. We opened with a gap. We broke structure here. We closed above all of this. Mostly, we closed above the previous day here. How did price close? In a breakout. Why? Because we closed above the opening and the highest point of this candle. If we close in a breakout, what did price do? You see what price did? Price came down first and then went up. Okay, good. I can delete this. We close in a breakout or in a fake out. When we come in this day, the two previous day are the one that we are looking at. We close in a breakout again. Oh, so what am I targeting? I'm targeting these highs here. What this price do? Price opened here, created this low, and then went up. You see how you could have catch a buy? You catch a buy where? Here. You catch a buy where? Here. You catch a buy where? Here. You have 1, 2, 3. 3 days of trading correctly in the right direction. Now here, we opened, we broke out, and closed in a breakout. Now, our target is this guy here. What did price do? Price opened, went up first, and then came down. But when it goes up without going down, are you still trying to buy? Let me see what you see. How do I wasn't going to come back and fill up the liquidity? It stayed above it for the weeks. Yeah, it can come. It depends on the news. You should know why the gap happened. Most of the time, this type of gaps is on the beginning of a month. And also, if you go, you look at the news, you will see that something happened here and pushed it. The thing is, after the close in a breakout, I'm not expecting price to come in the gap right now. I know price will come in the gap later because it did come to to test this gap. And even later, I think price will return here. You can see the gap is pulling the price down, but that doesn't mean that it has to come right now. Okay, so don't think that as soon as you have the gap on a higher time frame, price will come and fill it. You can still have weeks, even months to come fill a gap. It's only when you are inside of the M15 or M30 that the price will come and fill it. Okay, so I got it. So guys, you can ask your questions as soon as we are going. It's for you to understand better. So now here you see this price started and went straight up. Most of the time it will happen before your session, so you will not make a mistake of buying. And when you see price dropping, you will ask yourself, I already touched the target and the target was so close. You need to look at that moment on the left side. You look at the left side. Why? Because the left side will tell you if you are inside of a rejection zone, okay, that I can see here. It's a broken in fair value gap that you have here. It has been tested and then retested down, but also this is an engulfment that have pushed price lower. Okay, you see even here you have the same thing here. Price came and retested it. Okay, every time that you have a big move that happened and created a supply or a demand zone, next time price will come in there, it will react. So when you see that price did not obey the rules, look at the left. Okay, let's go back. Now that we closed bearish, remember, I told you when we close bearish, we should sell. We should target what? This guy here. Okay, first thing first, should I buy or sell the next day? You should ask yourself where you are. I told you, when you see something that doesn't match the rules, look left. You have a fair value gap here. This fair value gap here with this imbalance has pushed price up with impulsive positive move. Then you had the candle of the next day form here, and it was on Monday. So this news was on Friday. Okay, this is no exception. It happens a lot of time. So here on Monday, you have an inside day. This inside day, it's a play. I told you how the candle must behave once they follow each other. If it's a breakout, you continue in the direction targeting the lowest point of the one that broke structure. Okay, if it comes inside, you go in the other direction targeting the other side of that candle. Okay, you can target up here. Okay, but now what happens when the previous candle, like this case here, is a bearish one? Let's put red, and the next one is green but stayed inside. Okay, the inside bar or the inside candle, the inside bar or the inside candle, like I'm showing here, it's a play, it's a setup by itself. When you see an inside bar, be happy because you just got yourself a trade. I'm going to show you and prove it to you. When you have an inside bar like this, you have the extreme high here and the extreme low here of the day that is covering the first one. Like here, we have this guy here and this guy here, according to this green candle, right? Everybody see that? We have the green candle that is contained inside of this range. When you have the inside bar, listen to me, guys. There are people that trade only this, nothing else. They trade the inside bar. It's a strategy. But the next candle, NCT, next candle theory that I'm just explaining to you guys, is a way to know and look at the candle by itself on a higher time frame to expect and to anticipate the next coming day or week. When you have the inside bar, write this down, please. This is a strategy I'm just giving out. When you have an inside bar, you should mark the low and the high of the smallest candle, the one that is inside, because it's the inside bar. That's his name, right? You mark the high and the low. As soon as price will reach here, you must expect a reaction. If price breaks out and come and close inside, okay, Even on a lower time frame, you can expect now price to go up. And if price comes and close below, not below the big one, the small one, you know price is as to continue lower. So you're going to wait for price action to do something like this. As soon as it breaks below here, you look for sales. This is it's like an indicator. Let's go and look for it. Let me show you now. Every time you see an inside bar, let me know if you see an inside bar. Okay? You can tell me the one that is around. Okay? You can look at the numbers down here and then tell me what date or what time do you see the inside bar. But I'm going to show you every time an inside bar with this tool, the parallel lines. When I give you the parallels of an inside bar, you will see when price break in one direction, what price does. Okay? Every time you see an inside bar, like here, let's go. We have one here. What price did? As soon as price break the inside bar, price gave us 2 days of bearish move. You see? And again, as soon as price rejected from this other side, it went in the other direction for 2 days. Same thing. Look at this. Another inside bar. Once you find an inside bar, you just wait for price to break it and then you continue. 2 more days going in. Okay? I'm looking for an inside bar. Look here. I have an inside bar here. As soon as price broke out, look how bearish it was. It came and reacted to what? To this level. So every time you see an inside bar, wait to see which side of the inside bar we get broken. And then you know that day will continue. Look again. We have an inside bar. Where? Do you see inside bars, guys? Guys, do you see inside bars? You have one here. Let me show you here. One here. Here. You see this? When we break it, yeah, smaller, it means the high and the low did not touch the high and the low of the previous candle. It's like the opposite of an engulfing bar. So the inside bar will stay inside, and as soon as price will break it, price will never come to the other side. 9 times out of 10. And look at this. When you have an inside bar like this, like it's almost at the same level, it still went down. Look at this inside bar. Do you see how many inside bars you have in a week or in a month? Once we broke it, okay, look at this inside bar again here. What did price do? After breaking down, price continued lower. For it to come and take this inside bar, it took like, I don't know how many days, but you could sell all of this, okay? Where's another inside bar? I'm looking for inside. I have another one here. And then I will tell you what the inside bar is and why it's working. And even if it came, tested only this key level and melted. So if you start using the inside bar, okay, I just gave you something. You could just look at inside bars on the chart. As soon as you find one on the daily time frame, you wait, you mark the high and low, and you wait if price will break it. Inside bars are just an explanation of a compression. And a compression is a triangle. A triangle is a consolidation. And what comes after that? A manipulation and expansion. That's why after an inside bar, after we broke it, price will never come back. It's manipulated and it will go in one direction. An inside bar, it's that kind of candle. You have another one here, inside. It stayed inside, did not break the highs, and did not break the lows. And here we have when you broke it. Let's go now on a lower time frame and let me show you how price behaved when it happened here. Look at this. We had this inside bar, price created a high, and as soon as we broke it, price never came back. If you are on H1 or M15 or M5, whatever you want, let's go and see here, price never came back. So when you have an inside bar and it's got broken like this, you look at the session that you're trading, and if you find yourself retracement level where price could have come before breaking the structure, like here, you can buy. Now here, if you see this demand zone, after the break of the inside bar, you take your buy. Do you understand, guys? This is the first way to trade the inside bar. Second is to pick a big number. The big numbers are the 00s, the 50s, the 0.50s, the 0.75, and the 0.25. So you have 0 here, and then you have 1 here. You will have 4 levels inside. You have the 25 and the 50. But inside of 50 and 0 here, you have the 75. Okay, actually, it's 1 here. It's just the opposite. You have 4 levels. You have the zeros, you have the 25, the 5, and the 75, and back to 0. You see? This is how you subdivide the level. And this will happen most of the time. You will see if you find yourself a big number above or below an inside bar, you can trade it in one direction. Look at this. If you have an inside bar, okay, let's look for a 0. Let's look for a 0. Okay, I will take my horizontal line. I have 154.00. Let's go and see it. You see the coordinates like that. Boom. Do you see that? Let me put it in red and bigger. This is a 0 number. What did happen? It was just close to this bar here. As soon as price broke the inside bar, it was Asia. But during London, it broke again. Now, this is my playing field. I'm waiting for price to give me a breakout structure here, retracement 50%. You see what? 50% of this small range, and you can take it by. You see, exactly at the 0 level. Here, the bounce happened at 75. You see that? The institution don't put random numbers. You see this? It bounced at 75. If I come down here, it's a big number. It's a big number. I already see the big number. This is a big number. You see? So the price bounce on numbers. Now, if you take your big numbers and mark them around this inside bar, you can expect to know what price will do tomorrow, because when that inside bar created itself and stopped there, when the day started around here, we already know we are bullish, but we are waiting for a confirmation. We broke the inside bar, and then we continue during our session, we take a buy. And look how price continued. These are 15-minute time frame. And if you go on the daily and you find another inside bar, you will find another reversal. And that's how it works. So whatever you're looking for, it's inside bars and engulfing candle range. Engulfing candle range is like this. You have a small and a big one. Inside bar, you have a big, like this, and a small one. All of them are expressing a reversal. Okay? You only have two plays, inside bars and engulfing candle range. Engulfing candle and inside bar. Inside bar range, engulfing candle range. You keep that in your mind, and we forget step one. Type zeros in the chat if you got some value, guys. So this is what you have to find here on a daily and a weekly. The rest, I've already shown you the rest. The rest is to find market structure, to confirm your bias, and select a valid ECR. ECR is engulfing candle range on H4. Okay? We can go now here. We can go back here. Let me choose here real quick. Sorry. We take this quickly. I need to show you this. Okay. Let's now, you understand how the candle close. When the candle close above, you continue. When the candle close inside, you go in the other direction. When it close here like this, it's even more bearish because it will be a red candle. And when it's inside, like it's an inside bar, you already know the high and the low of that inside bar. As soon as it's broken, you observe if price will continue or it will reverse. And as soon as you have the confirmation, you can continue. The next day, you will go in the same direction. Okay? So if you use these three approaches that I just showed you on the pairs that I showed you here, all these pairs, you will not miss a trade. Per week, you have like 5 or 6 trades. So now here, if we go back, we said already what we know about the direction. Now we are thinking of what we should be trading and at what time. We chose, for example, for this, just for an explanation, I'm going to take the USD that USD CHF that I did today. I'm going to show you here. First of all, I'm going to delete everything. We have to think about the engulfing candle range. We have this black candle here that is engulfed by the green one. This is our demand zone. Okay? What do I say demand zone? Whatever happens in here, we need to buy. And this is now the definition of our bias. Whatever happens here is we need to buy. If we find another one like here, it will be called our supply zone. Whatever happened inside here, we are going to sell. We cannot buy inside here. We can buy here, and here we can sell. If you mark your daily candles like this, and then you mark alerts, as soon as price will arrive here, you will now know what to do. I know I have to sell. But how do you look for sales? That's what I'm going to explain to you now. The first thing is, as soon as price go out, to create the engulfment and go out like this, you're expecting price to return in the engulfment. Why? Because the engulfing candle is a sign of reversal, and most of the time on a lower time frame, it's a zone where a lot of buyers were there. And remember what I told you, price will go in one direction and will come to rebalance. The rebalance level most of the time will be the demand zone, and the other direction, price will go back in the supply zone. So if I mark my H4, because this is daily first, if I go on H4, I have to look at price coming back inside my daily. Okay, the daily engulfment, the ECR engulfment. When price will reach this level, what am I looking for? I'm looking to see if price will create another engulfment on H4 inside the daily engulfment. That's what I'm doing here. I'm going to mark, I saw one engulfment here, I have one here. You see this? Engulfing means what? The candle is covered from up and down, and most of the time I will consider only the direction the candle covered. Like here, it did not cover the lowest, but it covered up. I will take that in consideration as well. But the strongest engulfment will cover the up and the down of the candle, the top and the bottom of the candle, and engulf the total. It's like the opposite of the inside bar. Do you get that one? That part? It's the opposite of the inside bar. So now, here, you have this, guys, inside the daily. The H4, you're waiting. The H4 came back inside and created an engulfment. Now you have an H4 buy zone. The H4 buy zone is inside of your demand zone. This is where you will work your magic, because from here, price will now project. Let's go back to the checklist so you can see. I will mark market structure, confirm bias and direction, selection of the ECR. How do you confirm your bias? The bias is simple. You just need to see if price will break an H4 level. And how do you see the H4 level? You will go on the line chart. Look at here. Price was going down and down and down and down, and at some level it reached our daily zone. But did we break any structure until here? No. Until when we broke structure, is validated our bias, validated our direction. Why? Because if I go on a daily and I mark the lowest valley here, you will go and you will see that the price wicked this line, and this show the rejection of a daily key level. But what you should really think about is only, did we have a break of structure on H4 after touching this key level? So if you are in doubt and you don't know if the direction is right, you go on the daily time frame, you look at the key level, and the key level will show you if there's a rejection or not. And when you see the rejection, you validate with the H4, you have the engulfment, and you also have a break of structure. You see, this is what you are looking for when you come on H4. You select a valid ECR. Now, to select the valid ECR, okay, you will go on the M30. And I will tell you why, because we have the criterias that are here, down here. Now, I've selected this one, okay, this engulfment. This is the valid one. You can select many engulfment, but in this case, we have only one. You can also find this, but it's a bearish engulfment, but you don't care about that, okay? You need to choose the one that broke structure, the one that pushed price out of the daily zone. When you find the one that pushed price out of the daily zone, you have the perfect engulfment. You could have taken this one as well. It's also an engulfment. There's no mistake. It's okay. It's perfect. But I prefer to take the one that swept and created this reaction. Okay? So select the valid engulfment. Let's go now on M30. M30, you will mark the valid ECR or broken ECR on M30 inside the H4 zone. When price comes back, mark the setup formed before the break on the retest of the M30. Okay, let me show you. What do I mean by that? When price start going out like this, you drop now on M30. And whatever you're doing, you're observing price. The H4, let me put the edges so you can see them. The H4 is edges. You will put an alert around the edges. The alert will be where? Let me show you. Here. This is where the alerts will be. You'll be waiting for price to come back. You'll be waiting for price to come back. As soon as price will hit this zone, okay? As soon as price will hit the zone, you will come and you will see what price did on M30. So we went out of Sorry, it's already played out, but I'm just trying to explain to you because my replay button was not. Let me show you. Yeah, as soon as we go out of the H4 like this, okay, what you want to see is price return here, and it will alert you. And when it does, and it comes inside, you are looking for an M30 engulfment that will break structure. You have one here, okay? You see, you have one that's here, and price came back and retested it. I'm going to remove it so you will see everything. So when price went out of the H4, okay, because you have the H4 here, you have the daily push price out. Then you had the H4 engulfment inside of the daily here before it came back. You have one H4 here. Then this is the most safe one. That's the one I'm teaching you. When price comes inside here, this H4, you go in M30. When you come back inside of M30, you will look for an engulfment on M30. And from where you will place, we have one here. We have this one is an engulfment on M30, first leg. The second one, first leg means the leg that created the H4. The second one is this broken here, broken engulfment. Like I told you, you have broken engulfment or an engulfment on M30 inside the H4. Okay. Mark the first touch as option 1 and second for option 2. Okay. Now look at first touch is this one. It's option 1. Okay. Second touch means what? It means after the price has come back and tried to break out of it. You have, if you look on the line chart, it's easier for you. When did we break structure? We broke here. On the line chart, you can see it. We broke structure here. And price came back inside our engulfment. You have two types of engulfment. You have engulfment, simple engulfment, when you have a candle like this, and then another candle that comes and cover it. You also have another one like this. You have many candles that use their strength to cover it. Okay, you can have 2, max 3 candles to cover one candle, and that's move. If you look on a higher time frame, it's just one big candle covering this one. Okay, that's why it's this is a complex engulfment, and this is a simple one. So here we take the engulfment, the black candle, the last bearish move before we go up and break the structure, because we broke structure here, remember? This is our option 2. This case is a little bit complex, but I had to show you this because I want you to know when you reach a certain level and you don't understand what's going on, you go on a line chart, and the first break of structure out of this H4 zone will be your option 2. Let's go back here. Now, what you do next is you focus on the criteria. To validate your M30, you must have the ECR in the direction of the trend, the higher time frame ECR. Remember, it was bullish. Are we bullish? Yes, it's valid. Secondly, the criteria has no outside liquidity above or below. It means we already took liquidity down here, so we don't have any liquidity outside of our ranges. That's good. Third one, has formed a strong and high, strong low on M30. A strong high and strong low means what? It means we had a sweep and then a break of structure. We had a sweep here before our M30, because this is the M30 I'm talking about. We had a sweep and then we had a break of structure. Where's the break of structure? Here. It means this guy is a strong low. is stronger than this one. But the first option is the best option here. So after that, you has created an imbalance and a break of structure. We already know we had a break of structure, and we also see that there's an imbalance here. The imbalance is validating our zone. Okay, even this one created an imbalance later. So now the second option did not create all that. Okay, but you will not know why, because your price action will be here. You will not know about the second option yet. It's when you come late that you will care about the second option. The first option should be enough. And here, after creating the imbalance, breaking structure, price came back inside of your option one because it's the M30 engulfed candle that broke structure and took liquidity. You will go here and check if it's the right zone, premium or discount. Remember, if we have a range, you pull up the 50% fib, like from here to here. Where are we? Premium and discount. We are down here in discount zone. Okay, so it's correct criterias. And fresh and original, it's a plus. It's like if it was not used yet, it's a plus. But it was used, you should see if it matches with your time, like the time of your session, you can still take the trade with the same option. So now, after validating your criteria, you drop on M5 for your entry. Some people will take the position from the M30. They will go here without going deeper. They will stay here on M30 and take their position and targets something like, I don't know, here, up here. Okay, they will take a trade, protect below this, and this is a 3.5 hour trade. Okay, let's keep it here and let's go back on the checklist. Now, for precise and aggressive entry inside the valid setup that you marked, okay, the last M5 ECR or M5 broken ECR before the break of structure, and wait for a retest. Now let's go back here. It's crucial to read how liquidity formed and also what time is the retest. Check if any news could invalidate our trade idea, okay? And you can enter on the valid M5 ECR, okay? Stop loss above or below the setup. The setup means what? The option that we have, and target opposite the M30 ECR. The opposite M30 ECR is, according to this move that we are targeting on the daily, where is the opposition? We have another M30 here, engulfed, that could be the target. This is where price should stop. This is the first one. We also see another one up here that broke structure, this guy here. Okay, so now when I'm here, I will drop on M5 and go on my window session, wait for price to give me something. We said I must see a break of structure on the M5. Let me lock this guy here. And when I see the break of structure on M5, like here, if I have one, I will mark the last M5 that engulfed this guy here. And this will be my entry. Okay. And I will, these are 5-minute candles. So you don't need to wait. Okay. As soon as price will break, you see, price broke structure. We started the first trade. Let me see if we're gonna come back here. You came back in the M5 and moved quickly. But on the M5, you'll take a trade like this. You enter from the M5 and you will take just below the setup, something like here. You see how aggressive it is. The stop loss is smaller, and you will target the same level, knowing that we are targeting these oppositions. And this is how you will get a 6-hour trade instead of a 3.5 hour trade. And from here, price will play out. If you go on M15 or M30, you can see it play out quickly. And that's how it bounced. And you see how we could have take profit here, 4.9, and here it's a 2.2 R. Okay, this is the ECR fractal model. What we do is we find a daily engulfment. Inside the daily engulfment, we look for a H4 engulfment. Inside the H4 engulfment, we find options to find our setups. We have option 1 coming from the leg of the H4, option 2 coming from the retest inside. When we retest it, we can mark the second option. And inside the option, we wait for price to break structure, and then we can take our M5. But the options, we must remember the criteria to pick the best one. And when you pick the best option, you can take your trade on M5 just from a break of structure and a retest, and target the opposition of the M30. The opposition means if we are entering from a demand zone or an option on M30, here it should be an M30 supply zone. Okay, so how do I call this? Target. Yeah, this will be my target, and I will just let price play out until it reaches there. This is what I did on USD CHF. This is what I'm doing on gold right now. This is what I did and what I'm expecting to do on GBP USD. Same thing. You had an H4 here, which is an example. You had an H4 that came from an H8 engulfment, which was the refinement of a daily engulfment. Okay, once I had that, price returned in my zone on H4. Once it touched my zone, I went on M30. I marked this M30, but I called it a trap. Why? Because it did not strip liquidity. It created equal highs, and this equal highs was just a sign that price will come later to take it out. And it's got took out here. You see? So this was the perfect setup today, and it did retest it quickly before the news, and look what the news did. So you had the retest on M30, you had the option 1 inside here. When you go on M5, you see we still have the option of M5 untested, but the M30 already gave us a trade, protected above the setup, broke here, and sold with the news, targeting these guys here. So this trade is still running. I did not send it, but it was too quick with the news, and I don't want to send trades about the NFP. But here you have a trap, and I knew price would come back. But according to what I told you, being on an M30, I had to target the opposition. The opposition was here. That's why I looked for a key level inside the opposition and targeted. You have the big wick showing rejection, and if you go on H2, I think, or H1, no, H2, I think, yeah, you can have your target here. Exactly. If you look on M15, you can find a quicker way to get out, but it's for this case, it's the same thing as the M30. You see? So the target, it's here. You came from an M30. This is the option that you have, the first one. And inside of here, you could have a M5. The M5 is coming from here, you see? This is the entry sell. And price came exactly at that level. You protect exactly above the, let's call this option 1. I don't want to call it trap. You see, this is option 1. Price came, tested. I know it's a weak zone because we have a higher here, but the M5 still gave me a trade. Why this M5? Because it's the one that broke structure here. And as soon as price came back, tested the M5, protect above the setup, the option, my first option, and I would target the opposition here, and price came and gave me the trade. See? So this is the strategy I was talking about. You have the old checklist here. You know how to anticipate the daily and the weekly. I gave you the inside bar, the engulfing bar, and the next candle theory, telling you when to expect a buy or a sell according to how the candle closed compared to the previous candle. The H4, you just look at market structure, you understand the previous breakout, the previous swing high and the swing low, so you know in which direction you're going. If it's difficult, you go on a line chart, and if you have a rejection from the daily key level and the H4 has created a break of structure, then you know the direction you want to go in. And then in that scenario, you have to find an engulfing candle, and this engulfing candle will be where you want to play out. Everything that you will do will be inside that engulfing candle. So you wait for the M30 to come back inside. You look for the first one that will sweep and respect all these criterias. Okay, sweep liquidity, no liquidity below it, break structure and create imbalance, and is in the right zone, premium on discount, and is also in the direction, the same direction as your H4 and the daily, which is the higher time frame ECR. Then you come back when price comes back inside, you wait for it to start going out, and then you put your alert and you go back on M5. M5, it will be where you will enter, because when price comes to M5, you wait for it to come inside, create a reversal, and when there's a break of structure, you mark the first engulfment, the last engulfment before the break of structure, and that's where you will enter. You put your stop loss below the setup, and you target another M30 ECR that is opposed to your move. You can have target 1, you can have target 2, like we did here on USDCHF. You see, you had target 1 here, this is target 2. Okay, guys, this is the complete strategy. There's no other thing that I have to tell you about it. You just need to go and train yourself, take your time and practice on the charts, back test, take small accounts and try to trade them. You see, even when there's news, it's not opposed to our strategy, because we are doing all according to the higher time frame. We have a H4, then an M30, then the M30 gave us one trade yesterday, and now today we had a sweep. Why? Because this in the criteria list did not sweep liquidity. Even if we had one here, it did create liquidity above it. So we know price could come here and take this liquidity. And when you have equal highs, in this case, not equal lows, when you have equal highs in this case, price will come and take out, break structure. As soon as it breaks structure, it creates an M30 setup. I'm waiting for price to come back in the M30 and give me a trade. And this is my M5 sell. I'm waiting for price tomorrow to come here. I'll put my alert. If I see this, guys, I will send a trade. I will take the trade on M5, protect above my option here, which is my setup, and I will target the opposition. Let's go on M30 and find our target. Where is it? We have here the target. You see, this is the target where we will stop our trade for tomorrow. Sorry. What did I do? Back to chart. Okay, now you take here and put the target as target. Good. So this will be my take profit 1. Let me see if there's an H4. Yeah, also here is an H4. So I think price will stop here. But you can see the second engulfing candle, complex 1, because you have 1, 2 candle engulfing this guy. This could be the second target. I will just stop around the level here, and this could be my goal 2. It's also a target. Okay, guys? So this will be a trade for tomorrow. You see how with this strategy, you don't need to stress. You can wait and already mark your levels, waiting for this M5 being retested. Because the M5 here, it's equal to the M30 and also the M15. They're all the same zone. That's why I know it's the strong one, and I know price will come and retest it. How many pips or stop loss? We can put 35 pips, and then the rest of the day will give us a move. I think this will happen in 2 days, not one. But also, if you are aggressive, you can protect here. But I would recommend you to do this. What I do most of the time to reduce my stop loss, I would just find a key level where I think price will never touch again. As we had this rejection, where is the peak here? The peak is here. This peak is where price will never return. And if we test it, it's okay. But I will put my stop loss right above this and keep myself on a 20 pips stop loss. You see, that's how I can reduce it, because I know if price comes and break this resistant level, which is a key level, you can see even here, you can see here, it's a strong level that's rejected price lower. And on H4, we already have a breakout structure. When you go on a line chart, you see, we already have a breakout structure here. So I know price is going down, okay? So I can protect my stop loss here. And if price comes and take me out, no problem. I will just wait for it to drop again and put a sell stop, and we can continue, okay? But this is the move that we were waiting, that I've been talking about since Sunday, because on the weekly time frame, the previous week was bearish, and we expect this to be a bearish week as well. Remember what we're targeting? This is where we're targeting. This is our target for the next week, because this is the lowest point of the previous week. So if I go on M15 or M30, you can see the big black line here. If I put it green, this should be the target, okay? But I'm conservative, I will target this one here. So that's it, guys. I think you understood everything. There's no other secret. You know, okay, this recording will be on YouTube. I've been saying that for like 2 weeks now, but I had so much stuff to do, but I will do my best, guys, to put this this call on YouTube, so everyone can enjoy and come back and review whatever we explained here, okay? The part that is more tricky is to select the best setup. That's all. And for that, you have to know how to read liquidity. And I have a video on liquidity already on YouTube right now, so you can just go watch that video and it will help you understand liquidity. That's it, guys. So thank you again for being part of the call. Put the zeros in the chat, guys, if you feel like you've learned something and if you get some value. The thing is, you can use this strategy on everything you want, and it works the same, okay? It works the same. So thank you again. Take care of yourself. We will have a call on Sunday, and then next Monday, I think. Yeah, Sunday, Monday, and maybe Wednesday again. And yeah, just be alert. Tomorrow I can send a trade on GBP USD. I have an alert here waiting for price to come back. This will be my internal range liquidity, where price will probably come back and give us the opportunity. I'm expecting this to be run, and then price will touch our level and drop lower, okay? So that's it. That's all. I'm in a gold trade. I just bought this. Yeah, I have one that is already in green. The second just entered. But that's it, okay? So see you guys. Thank you again, and take care of yourself. I will put this call on YouTube, and you can go and practice from there, okay?